Hey guys, welcome to another weekly update brought to you by Economotion, and this week as well brought to you by Capital Trading Group, one of our introducing brokers that we use for Magna Libra. And I am Mike Agney, the CTA manager of the Blue Dragon Global Macro Discretionary CTA program. Here you can see the Economotion website where we post our weekly blog. Go here, you can check out what we wrote in the past. We try to talk about the things that matter for the upcoming week. Update the prior week, important things that we think investors and traders need to know. You can go to Capital Trading Group's website here, capitaltradinggroup.com, and find out more about their futures and brokerage services. This week's title, The Calm Before the Fed Storm. First off, we got to go to the confidentiality and risk disclosures, as we are an NFA registered CTA, and you can see the Magna Libra tagline here, the key to unlocking your portfolio's potential. Okay, first up, we're going to go to the CME Group Fed Watch tool, which is showing the July 31st FOMC meeting with 100% 25 basis point cut shown here, and 22.5% of the market participants actually think we're going to get a 50 basis point cut, which is denoted here. So 100% 25 basis point cut is baked in. Some 1/4 of the participants are thinking a 50 basis point cut, and over the following next few slides, we're going to go over as to the rationale for the Fed's totally reversing their course from earlier this year and going to a cut bias. Why the Fed has to cut? Our reason number one, the 5-year rate plunged in late 2018 as stocks got hit, as you can see here, as the inflation rates, expected 5-year forward inflation rates have plunged. Despite the equity recovery, inflation expectations still are muted here at 1.6%, so well below this 2% threshold. And you can see historically here that these break-even rates they rarely get above this 2% here over the last 4 years. So this has really put the Fed really behind the 8 ball here as the inflation rates are plunging, yet equity markets are still moving towards their highs. So this is between a rock and a hard place, to say the least. Why the Fed has to cut? Our rationale number two, the U.S. dollar index is up 22.25% since mid-2014, as you can see here. So a strong U.S. dollar, what does this mean? The strong U.S. dollar puts extreme pressure on global short base that require payments to be made in U.S. dollars. Think about all that U.S. debt out there, and think about all the interest payments that need to be made. Now think about being able to acquire U.S. dollars in order to make those interest payments. So that's what we're seeing as the Fed embarked on their rate hiking cycle. They put extreme pressure on global economies and extreme pressure on emerging market economies, and a stronger dollar. When you're loaded up to the hilt in U.S. dollar denominated debt, and you got to make interest payments in U.S. dollars, well, this just exacerbates your position. So we like to call this the hashtag shortage. So I think this move has caught a lot of people by surprise, yet the dollar is continuing to hold its strength here, despite the fact that they are about to embark on a interest rate lowering or cut cycle. So we'll see where this goes. Like I said, and what we have talked about time and time again, things don't always transpire as how they did in the past, at least not initially. So it's going to be interesting. So we live in certainly in a new dynamic, new paradigm. I just put together this little graphic this week, and we're going to call this "Why the Fed Truly Has to Cut." Rationale number three. So the FRB remittance to the U.S. Treasury has fallen 44% from its 2015 peak, which is denoted here at 120 billion, and now we're down to a little over 65 billion here. But what's interesting to note is that in 2010, the Treasuries owned by the Federal Reserve stood at 776 billion, where today we're at 2.3 trillion. So it seems a bit odd to us that we have 1.5 trillion more treasuries, yet our profits, remittance to the U.S. Treasury Department is lower than in 2010. So it seems a bit odd. We did reach out to a few people on Twitter, and Jim Bianco, who's if you don't follow Jim Bianco on Twitter or follow his stuff, he's an excellent fundamental economist and researcher, and he told us that a lot of this has to do with IOER and them paying the 35 billion or so to the banks through the subsidy. And it does make sense, so we would be up here if there wasn't any IOER, but it's still, I'm not buying it. Something seems off here, so maybe the Fed's not making as much money as they say. And then he also went in to talk about how they roll off their bonds, so they're not taking keep buying. Once debt payments roll over, they don't rebuy bonds, which would, increase their purchases based upon their capital appreciation. If the price of the bond went up, they'd sell the bond for a profit and then buy more bonds because of it. But he's saying because they have not gone to a quantitative easing as well as purchasing more treasuries, that this has not led to an increase in their profits. So we'll see if that changes if this number goes up. So it'll be interesting to note. But this is why we also think because that the Fed has to cut, because they need lower interest rates so their bonds can appreciate the ones that they already currently own. Why the Fed truly has to cut, number 4. So we saw this Michael Guy, another guy that you need to follow. He's at the lead lag report. He put this out earlier this week. So this is the New York Fed Recessionary Probability Index, and what it's showing is that since 1960, a breach above this 30% level here has a recession prediction accuracy rate of 100%. So we're already above it. So if this holds true now, we are moving into a recession currently. And so once again, the Fed is trying to be proactive and cut rates and get ahead of the game here. But will cheaper money solve that issue? As we know, that the concentration of wealth is moving quite vastly towards the top 1%, and the rest of the mainstream economy is really not benefiting because the debts are just way too high. So it's like called pushing on a string. People won't borrow if they don't feel that the future prospects of paying that borrowing back is there, and that's what the dilemma that we're running into. So a couple technical charts to consider here. This was last Friday's chart. End of day, the S&P 500 took a hit, rare Friday hit, closing near its lows. Of course, we expect the back and fill, and I think we're trading, above the lows, mid 2990, 2980 area today. So expect back and fill up to that 3010 key level upside area, which is denoted here. And the earnings this week will be the driver for this, of course. But this double top, it was clear on Friday that somebody had the sell program in there, and they weren't going to let it go. They put the overnight high in. They tried to touch it again early on, but then just failed the rest of the whole day. Actually, the sell program was, in action. Silver had a great run. SEP Silver put in a powerful move last week. Silver's up 14% in 2 months. 1650 is our big level here. This is will be the breakout of the 1-year base that they've put in here. As you can see, got up to here last March, trying to sneak above that 1650 again. We're currently not there yet, but silver's break above $15 saw this immediate jump from here to 1640. So once again, keep an eye on silver. We feel that the silver ratio to gold has been broken down too far, that gold is outperformed it way too far historically, and that this may outperform gold in the near term and longer term future. So let's keep an eye on silver, guys. And here you can see this is the gold ratio, the gold versus silver ratio going back to 1990. Now we're up here in this 90 to 1 ratio up here band, and we're just dipping back below this here. Currently with gold 1427 and silver 1641. This is an indication ratio of 87 to 1. So just to put this into perspective, if gold does underperform here and silver outperforms, we even get back to just somewhere in here historically norm area of 70. If gold stays at 1427 and the silver ratio returns to 70, the silver price would be up at 2038. So from $3 here, so you're talking about at least close to a 20, little less than 20% gain from here. So silver is definitely on someone's radar. Somebody is putting on that trade, and we saw that in action this week. As far as the U.S. government 10-year Treasuries, still hover around 2.05%, and you can see here we've had a couple dips below it over since 2012. Going back the earliest time here is now currently, the last time we were back here was the end of 2016. So we'll see. Now the Feds, they're not in this cycle here. They were raising rates, and now we're cutting rates. So we expect this to just continue downward and pressure these lows down here at I think this was 1.3, maybe 1.43, somewhere in that range, 1.43, 1.47 area. Sorry, I don't know why that's coming up there. So keep an eye on this. Actually, this says 137, so we'll see. 140 seems pretty formidable. but this 1.37 we did denote as a possible target. So keep an eye on the U.S. 10-years as the Fed embarks on this interest rate cutting cycle. So what are the keys earnings this week? We know Thursday is Amazon, the big name here on the 25th, and we look at an Amazon chart here. Our 2025 level is obvious upside key level here. This is a triple top, and if they take this out, we are going to get a good push. So we wouldn't be surprised to see off this earnings a pop above here, but if we trade back below here, that'll be a huge negative sign for us. Right now, key is probably somewhere more near the 1913 area that we're looking here. If we break below 1984, start to trade down on this earnings number, 1913 would be our first target here on the downside. So keep an eye on Amazon this week. Obviously, there's other earnings out. Chipotle, Ford, PG&E, which we've talked about at length over the last couple of years, and all the mess that they've created. Hershey's, Amazon, Comcast Thursday, and Twitter on Friday. So earnings will be driving it this week before pre-FOMC next week. So keep an eye on Amazon this week, guys, for overall market indication. So this chart shows here, I put this up before, we put this up prior, the Bitcoin and gold rises, the Fed moves to lower rates. So the Federal Reserve lower rate policy seem to be driving both Bitcoin and gold higher, and both are excellent stores of value. One from the future and the other from the past. So we like them both here, guys, so just keep an eye as Fed, once again embarks on this cutting cycle. These stores of value should continue to outperform. And speaking of, even Fed Chair Powell talked a little bit on Bitcoin as a store of value here at the Senate Banking Committee on July 11th. So let's listen in here to see what he had to say.
Currency system were to become prevalent throughout the globe, would that diminish or remove the need for a reserve currency? In the traditional sense?
I think things like that are possible, but we really haven't seen them. We haven't seen widespread adoption. I mean, Bitcoin is a good example. Really, almost no one uses Bitcoin for payments. They use it more as an alternative to gold, really. It's a store of value. It's a speculative store of value, like gold. So we don't have, and people, of course, have been talking about this since cryptocurrencies emerged. But we haven't seen it. But that's not to say we won't see it. And if we do see it, yes, you could see a return to an era in the United States where we had many different currencies, and in the so-called, I guess, national banking era.
So it's good that Powell is actually, we know it's on the Fed's mind. We know it's a lot larger than what they want to lead on to. And the guy in the back right kind of cracks me up, reminds me of an old professor. But anyways, it's good to hear Powell at least speaking of it and not hiding it. So it is on their minds, and we know it, and it's good to see him bring it out there in the Senate Banking Committee hearing. I thought this was great, too. Sorry about the swear word that their congressman's going to use here, this is what they're going to say. But we thought this was a excellent testimony on the veracity of Bitcoin. And Melton Demers, Chief Strategy Officer at CoinShares, put out a great explanation here, testifying at the U.S. House Committee on Financial Services during examination of Facebook's Libra coin, which we know is not a true cryptocurrency due to its centralized nature. But this was on July 17th, so let's listen in here.
Highlighted a lot of background information about Bitcoin and about the immutable distributed ledger and the benefits of that, decentralization versus centralization. A lot of people in this space will use a phrase that you may be familiar with. There's Bitcoin and then there's shitcoin. Are you familiar with that phrase and what people might mean by that?
I am.
So could you elaborate on how people would differentiate the two?
Absolutely. I think the idea here is Bitcoin has had a long track record. The network has been operating for 10 years. The Bitcoin network has been tested. The decentralized nature of the Bitcoin protocol has been tested. People have tried to co-opt control of Bitcoin source code and push it in certain directions that benefit their business models. And this network and this protocol and its open source governance have withstood that test. It is robust, it has been tested, and it has had the benefit, frankly, of spending its first 5 years in its nascency, sort of operating in this environment of innovation and not having a lot of regulatory attention.
Is there a central authority that could dilute the value of Bitcoin?
No.
Is there a central authority that could filter transactions at Bitcoin?
No, that can only be done through the products and services that people utilize to access the network.
Like Coinbase, for example.
Absolutely. That is
Okay.
a U.S. company that is regulated based on the facts of what its business model is.
Right, and so just like in the U.S., the Federal Reserve or the Treasury doesn't change the dollar. The people at the edges, the banks generally do that. But with Bitcoin, you can still engage in peer-to-peer transactions like cash, correct?
Absolutely.
And because it's open source code, you could have a wallet, correct?
Absolutely.
All these features are different than many of the things that people call colloquially shitcoin, because the value can be distorted by a central.
So I think she made some very important points there, and I think that's what people need to be cognizant of. That this technology is robust, and it's very hard to beat in terms of immutability, and we'll go into that a little bit here more in its decentralized nature. So let's go into the next couple slides, and we'll see here what we're talking about.
Highlighted a lot of.
So why do we like Bitcoin? It's because of its technology. So for you guys that don't know, here's 4 main points that we like about it. It's decentralized, immutable, permissionless, and open source, as Ms. Demures spoke about. So it was created in 2008 by the entity known as Satoshi Nakamoto. The Times 03, January 2009, Chancellor on the brink of second bailout for the banks. This was one of the first original Bitcoin tags that that it's known by, and obviously this is a disdain for central banking. So they knew right away in 2009 that this is kind of what they wanted to fight and what they wanted to create the system for. Whoever this entity is, or entities, or people, we don't really know. So it's a P2P technology built upon the electronic ledger known as blockchain. It's a digital distributed ledger. It utilizes mathematics and cryptography, and Bitcoin's a cryptocurrency which can be used as a medium of exchange. And one of the biggest things that we like is that its supply is capped at 21 million. Never can go above that. And we heard some argument on someone on Twitter talk about, well, you can create Satoshis and there could be a quadrillion Satoshis and that devalues it. And that's the stupidest argument I ever heard. I argued with him and I just simply said, hey, does the penny, nickel, dime, and quarter devalue the US dollar? Because that's exactly what you're saying. So it makes zero sense. So you get a lot of shills out there, a lot of idiots that have no idea what they're talking about. You also get a lot of guys claiming that they're cryptocurrency and Bitcoin experts, which I don't know anybody that's been involved with this from the beginning that would actually say that. They would actually be a little bit more discreet about it and know that they have the knowledge of why it exists and what they're doing with it. So keep an eye on this, as we've talked about at length, and you read in my blog at Econ Emotions, and we've talked about it for many years and been involved for many years, and it's really the technology that we're a big fan of. So here you can go in a little bit of a graphic from 101 Blockchains. There's a lot of great information out there that you can research and resource, and this is just explains the public versus private blockchain network. So on the left side here you can see what a public blockchain would do, and this is what the Libra coin would be. It's permissionless and open network. This is not what the Libra coin would do. This is Bitcoin, permissionless, an open network system where all the devices can freely access without any kind of permission. The ledger is shared and transparent. This is the realm over here to the right, the private blockchain that the Libra coin will be existing in. So it is permissioned. A user has to be permitted by the blockchain authority, Facebook, before he or she could access the network. The user might join only if she gets an invitation. So this is not true decentralized cryptocurrency. This is where the Libra Facebook coin would exist, and this here is the blockchain of Bitcoin, and what we like to always call and say, it exists everywhere and nowhere. So good luck trying to figure out what kind of quantum computing and power you would need to try to mess with this system. It's almost impossible. In fact, it is impossible at this point. Okay, so that's it. Any questions? We hope you enjoyed this week's broadcast. Once again, you can find our blog post at econemotions.com. You can learn more about Magna Libra Blue Dragon Discretionary Program at magnalibra.com, and you can learn more about Capital Trading Group here at capitaltradinggroup.com. I put in a wrong website there, so I'll have to change that. So capitaltradinggroup.com. So Magna Libra doesn't want to make up the majority of your portfolio, but rather we want to be a significant portion of your alternative investment allocation. So we got to put that little pitch in there at the end there. And once again, this is all for informational purposes only. We hope you enjoyed this week's broadcast, so we'll see you next week. Cheers.